Good morning, my name is Rob Newman and I am one of the partners at Carter, Collins and Meyer, accountants in North Manchester and now South Manchester because we've recently opened an office in Reddish, Stockport. So this morning's little video that I'm doing is about the changes to dividend taxes and why low salary, high dividends may no longer work for you. Now, I have touched on this before. This is a little bit more detail, but I'm still not going to open out an Excel spreadsheet and start doing loads of number calculations. Indeed, even as I speak this, I may not actually even quite remember some of the numbers right myself. So if I do and I get this wrong and there's some minor technical thing in there, please do forgive me and be kind. The general principles still apply. So what has specifically changed? Well, what has specifically changed is the direction of travel that governments have had. If we were filming this 20 years ago, by far I would be saying to you, you need to become a limited company and you need to pay yourself massive amounts of dividends because at that stage you could basically earn £50,000 tax free. And no, I'm not hallucinating, that is how it used to be. But in today's world, unfortunately, it's not like that. And from the time of filming, which is the 7th of April, yesterday, dividend taxes actually went up 2%. So the 8.75 becomes 10.75, the 33.75 becomes 35.75, and the 39.75% rate still stays as it was because even the Labour government couldn't bring themselves to raise a tax rate above 40% yet. What this actually means, if you add on to it the changes in corporation tax as well that happened a couple of years under the previous government, I'm not particularly biased, they're all rubbish. The overall direction is that you are paying considerably more. Indeed, if you actually just take across the last 2 years, your tax rate has gone up by well, at £100,000 of income, it will be nearly £3,500 of extra tax. It is a definite 22% tax rate that you're paying on most of the dividend side to things. If you take in the corporation tax rate, it's going to be nearly 45% that you're paying across your earnings at £100,000. So with this depressing and slightly wearisome news, what does that mean for you if you're watching this? Well, what it means is dividends may not be the best approach. Indeed, when you do some of these calculations, salaries can actually come out cheaper. And if you were wandering into me today and saying I'm about to start a company, I would seriously talk to you as to whether it's worthwhile becoming a limited company for tax purposes. Now, there are other reasons why you may want to be a limited company. MTD is one of the most obvious ones. MTD for income tax also started yesterday at the date of filming and it imposes significant burdens upon you. You're now doing multiple tax returns a year rather than just one if you fall under its regime. So it may be worth taking that dividend hit to take yourself out of the whole regime of MTD. The other side of things that you may want to consider is, do you actually want to be in, if there's a couple of you, a limited liability partnership? Indeed, at this time, I think limited liability partnerships, and I think they have been for a while, is probably one of the most tax efficient vehicles. They're not something that's massively seen. You do get quite a few of them around, often in professional services. You don't tend to see them so much in smaller owner-managed businesses, but they do suit, particularly, as I say, if there's a couple of you working together. Now, if you do stay within that limited company and you are set up as it is and the effort and cost of changing is becoming significant to you, what do you actually do? Well, one of the first things that I would say to you is, do you actually need to take all the money out of the company that you are taking out? And if you are taking out, what are you doing with it? Because a couple of the most obvious things to do is, if you are using your income to buy a car, could you consider looking at an electric car? Now, electric cars are not as tax efficient as they once were. Nothing is under the current regime, but they still present significant opportunities if electric cars suit you. The electric car can sit in the company. It will still qualify for 100% benefit and 100% capital allowances and will give you only a small benefit in kind. Again, at the date of filming, it's around 1% charge. The value of that can be significant because you can then put the electricity charger and the car through that business, reducing taxable profits, reducing corporation tax bills. And if you were going to spend this money anyway, it's something that's allowed you to do it outside of the scope of any form of taxation. The other thing, if you don't actively need the cash at this stage, is pensions. Now, I don't sell pensions. It's not something that I directly advise on, but I do talk about the taxation consequences of them. And the taxation consequences of pensions are amazing. They are the best bit of tax planning that is still considered vanilla that there is in the UK at this time. Your company can pay contributions into your pension scheme of up to £60,000 a year. That reduces your corporation tax, that reduces the amount of tax that you pay, and means that you are getting wealth into your name that hasn't had any form of taxation on it. Now, the pension can then be sat there, and it can be a normal private personal pension. You can turn it into SIPs, you can turn it into SASs, you can do lots of things with it. We will talk about some of the opportunities in pensions in other videos, but they're not just giving your money and allowing some big pension company to run it for you. There's many other things you can do. Particularly, as I say, if you're at the margins of things, because where this can become particularly painful for people is when they hit the extended rate of income tax. At £125,000 of earnings, or between £100,000 and £125,000 of earnings, the personal allowance starts to disappear. And at £125,000 of earnings, it's gone completely, which means your marginal rate of tax is around 60%. Pensions and pension contributions could be used as part of that way of not earning that level of remuneration, not getting that dividends, but still getting wealth into your own name. One of the other things that I often consider then as well is building pots of wealth outside of the existing trading company. Company-to-company loans, company-to-company dividends can fall outside of taxation and can be readily used to build up things like buy-to-let properties. Now, again, landlording is not what it once was. As somebody that used to be a landlord, I can do many videos on how difficult that world has become. But it is a significant store and generator of wealth for owner-managed businesses outside of their trading income. And it's something that would be wrong to completely discount as part of the mix of stuff that you should be considering. And if it allows you to retain profit within a company rather than paying it as that dividend, it is something that you should consider. Now, advice will be needed, and often that conversation with your accountant, your financial advisor, is going to be really useful if you do that. A word of warning, if you are looking at the property things, there's plenty of gurus around who will sell you expensive courses. And I would say to you, some of the best advice is actually available to you without buying into those courses. There are a couple of really good landlord associations that you can look to join for a relatively small membership fee. Something like the National Residential Landlord Association is one that will give you outstanding value if that's something that you're looking to do. Even if it is at the end of your time with them not to become a landlord, what you decide. So getting back to the dividend rates and the changes that are happening, the direction of travel on this, as I say, is unpleasant. Governments are not supportive of owner-managed businesses. They haven't been for a while. It's something that, ironically, it's probably Tony Blair is the last supporter of owner-managed businesses. And it's something that you're going to have to look at on a case-by-case basis. There's no specific number that applies. And as I have calculated a matrix of different dividend and salary combinations, you find that it can swing from one to the other across different ranges. And at this figure, it's this way, and at that figure, it's the other way. So essentially, tax-driven incorporation is over. The ability to just say it's going to fit like this is not there, and you are going to have to do some more work to it. Overall, if you consider the risks that dividends can bring to companies, which I've talked about in some of the previous videos, you may well want to consider having higher rates of salary and less dividends, particularly if your company has some cash flow difficulties. The salary route isn't something that insolvency practitioners can challenge if something happens to that business, and it allows you to protect yourself in a far better way than dividends do. But please do have that conversation, have that thought process with your accountant and consider some of the timing implications of those dividends, because things that people miss if you try to pay some of it early is the effect that it can have on your payments on account and your child benefits. So some things to think of, some of the positives, some of the negatives of paying dividends as it stands in the current regime. Do have those conversations, do reach out. I'm delighted to talk further about it. I hang out on LinkedIn a lot, and my name is Rob Newman, and I am one of the partners at Carter, Collins and Meyer.